Does incorporation in Canada reduce cross-border tax risk? When US owners decide to get serious about Canada, incorporation is usually on the table. One of the big selling points they hear is that a Canadian corporation can contain cross-border tax risk. That is partly true, but only if you understand what risk you are talking about. Incorporation in Canada does not make Canadian tax disappear. It changes who is taxed, how profits are measured, and how easy it is to show that Canadian tax is limited to Canadian business. Done thoughtfully, that can significantly reduce uncertainty and disputes, clarifying where the business lives for tax purposes. If you run Canadian operations directly out of a US entity, Canada has to figure out how much of that entity's global profit is really Canadian. That means permanent establishment analysis, branch accounting, and transfer pricing between head office and Canada. None of that is impossible, but it adds moving parts. A Canadian corporation simplifies the picture. It is clearly resident in Canada and taxed on its own income. Its accounts focus on Canadian operations, and intercompany transactions with the US parent are easier to identify and price. Instead of carving a Canadian slice out of a global pie, tax authorities see a separate plate, separating US and Canadian tax profiles. With a Canadian subsidiary in place, you can talk about Canadian tax on Canadian corporate income and US tax on the parent's income separately. The subsidiary pays Canadian corporate income tax and, where applicable, provincial tax on its profits. The US parent then deals with the after-tax dividends it receives using foreign tax credits and treaty rules to avoid double taxation. Without a subsidiary, Canada may tax branch profits directly in the hands of the US corporation, and the US system must be satisfied that those Canadian taxes are properly creditable. That can be more complicated to model and explain, especially when branch profit attribution is not straightforward, reducing permanent establishment ambiguity. Operating directly through a US entity in Canada always invites the question of whether you have a permanent establishment under the Canada-US tax treaty. Each new warehouse, employee, or long-running project can move the needle. If you misjudge and treat yourself as operating without a permanent establishment when Canada disagrees, you can face retroactive tax assessments. A Canadian corporation does not eliminate permanent establishment analysis entirely, but it moves most of it inside Canada. The subsidiary clearly has a Canadian permanent establishment. The treaty question for the US parent then becomes narrower. Do parent-level activities in Canada go beyond shareholder oversight and create their own separate permanent establishment? That is usually easier to manage than treating all operations as a branch of the parent, making GST, HST, and payroll compliance cleaner. Indirect tax and payroll are also easier to isolate when you use a Canadian corporation. The subsidiary registers for GST, HST, collects and remits tax on its Canadian sales, and claims input tax credits on its Canadian expenses. It also handles payroll withholding and remittances for Canadian employees under its own business number. If you instead run everything as a non-resident branch, the US entity itself must register for GST, HST, obtain Canadian payroll accounts, and keep those filings straight while also dealing with its domestic obligations. This is not inherently riskier, but the administrative tangle increases the odds of something falling through the cracks, where a Canadian corporation does not help. There are limits. Incorporating in Canada does not shield you from Canadian tax on Canadian profits. It does not eliminate transfer pricing scrutiny on cross-border charges between parent and subsidiary. It does not remove Canadian withholding tax on dividends, interest, or royalties flowing back to the US, although treaties can reduce those rates. A subsidiary can also add complexity on the US side. You now have a foreign corporation in your group with all the reporting that comes with that. You need to manage foreign tax credits properly and keep an eye on global minimum tax rules as they evolve. Risk reduction versus tax minimization. It is helpful to separate risk reduction from tax minimization. Incorporating in Canada is usually about risk, making it easier to show that Canadian profits are correctly measured and taxed in Canada, and that US profits stay outside the Canadian net. It may or may not reduce the total tax bill once foreign tax credits and withholding taxes are taken into account. Trying to use incorporation primarily as a tax reduction gimmick is less effective than it once was, because both Canada and the US now pay closer attention to profit shifting and hybrid structures. The best use of a Canadian subsidiary is to give you clean lines and fewer gray areas, not to magically undercut the tax systems on both sides. Final thoughts. Incorporation in Canada does not erase cross-border tax risk, but it often makes that risk easier to see and manage. By putting Canadian business in a Canadian company, you create a clearer separation between Canadian and US profits, simplify permanent establishment questions, and make GST, HST, and payroll compliance more straightforward. If your Canadian presence is more than a few remote sales, it is worth asking not just how much tax will a Canadian company pay, but how much uncertainty will it remove. Our website includes side-by-side comparisons of branch and subsidiary models that can help you answer that question in concrete terms. If you require assistance with Canadian tax matters, our team is ready to provide reliable professional support. Please contact us at 416-283-8774 or visit theaccountingandtax.com for more information. And if you found this video helpful, don't forget to like, subscribe, and share.